Hello and welcome to this beginner's guide to understanding crypto arbitrage. In this video, we will provide a clear and concise explanation of what crypto arbitrage is and how it works in practice. Whether you're new to the world of cryptocurrency trading or you're an experienced trader looking to expand your knowledge, this video is for you. So, let's get started. What is crypto arbitrage? Crypto arbitrage is a trading strategy that involves buying and selling cryptocurrencies on different exchanges to take advantage of price discrepancies. In other words, crypto arbitrage traders look for instances where the price of a cryptocurrency is higher on one exchange than on another, and then buy the cryptocurrency on the lower priced exchange and sell it on the higher priced exchange, earning a profit in the process. The profit earned from crypto arbitrage is typically small, but it can add up over time, especially for traders who engage in high-frequency trading. How does crypto arbitrage work? To understand how crypto arbitrage works, let's consider an example. Suppose Bitcoin is trading for $50,000 on exchange A and $50,500 on exchange B. A crypto arbitrage trader could buy Bitcoin on exchange A for $50,000 and immediately sell it on exchange B for $50,500, earning a profit of $500 per Bitcoin. Of course, it's not always this simple. In practice, there are several factors that can complicate crypto arbitrage trades. For one, there may be fees associated with buying and selling cryptocurrencies on exchanges, which can eat into the profits earned from arbitrage trades. Additionally, the price discrepancies that make arbitrage trades possible can be short-lived, meaning that traders need to act quickly to take advantage of them. To succeed at crypto arbitrage, traders need to have a good understanding of the cryptocurrency markets and the different exchanges where they can buy and sell cryptocurrencies. They also need to be skilled at analyzing market data to identify price discrepancies and executing trades quickly and efficiently. Types of crypto arbitrage. There are several different types of crypto arbitrage, including simple arbitrage. This involves buying and selling the same cryptocurrency on different exchanges to take advantage of price discrepancies. Triangular arbitrage. This involves using three different cryptocurrencies to execute an arbitrage trade. For example, a trader might use Bitcoin, Ethereum, and Litecoin to take advantage of price discrepancies between different cryptocurrency pairs. Statistical arbitrage. This involves using statistical models to identify price discrepancies and execute trades automatically. Cross-exchange arbitrage. This involves using multiple exchanges to execute an arbitrage trade, taking advantage of price discrepancies between those exchanges. The risks and challenges of crypto arbitrage. While crypto arbitrage can be a profitable trading strategy, there are also risks and challenges associated with it. One of the biggest risks is market volatility. Cryptocurrencies are known for their price volatility, which means that the price of a cryptocurrency can fluctuate rapidly and unpredictably. This can make it difficult for traders to execute arbitrage trades quickly and efficiently. Another challenge is exchange fees. Many cryptocurrency exchanges charge fees for buying and selling cryptocurrencies, which can eat into the profits earned from arbitrage trades. Additionally, traders need to consider the cost of transferring cryptocurrencies between different exchanges, which can also incur fees. Regulatory uncertainty is another risk associated with crypto arbitrage. Cryptocurrencies are not yet regulated in many parts of the world, which means that there is a lack of clarity around the legal status of crypto arbitrage trading. This can create uncertainty for traders and make it difficult for them to operate within a clear legal framework. In conclusion, crypto arbitrage is a trading strategy that involves buying and selling cryptocurrencies on different exchanges to take advantage of price discrepancies. While it can be a profitable trading strategy, it also comes with risks and challenges, such as market volatility, exchange fees, and regulatory uncertainty. To succeed at crypto arbitrage, traders need to have a good understanding of the cryptocurrency markets and the different exchanges where they can buy and sell cryptocurrencies, as well as be skilled at analyzing market data to identify price discrepancies and executing trades quickly. And if you're interested in trying out crypto arbitrage for yourself, there are several things you can do to get started. First, you will need to choose a reputable cryptocurrency exchange where you can buy and sell cryptocurrencies. Some popular exchanges include Coinbase, Binance, and Kraken. To execute an arbitrage trade, you'll need to transfer your funds between different exchanges. This can incur fees, so it's important to factor these into your calculations when determining whether an arbitrage trade is profitable. Additionally, you'll need to be prepared to act quickly when you identify a price discrepancy, as these opportunities can be short-lived. Overall, Crypto arbitrage can be a lucrative trading strategy for those who are skilled at analyzing market data and executing trades quickly and efficiently. However, it also comes with risks and challenges, so it's important to approach it with caution and do your research before getting started. With the right approach, arbitrage can be a valuable addition to your trading toolkit.